One NBFC's debt repayment default, and that's triggered serious concerns of a run on liquidity. Not that other financial institutions have not been able to honor their commitments, by the way, or find new buyers for their commercial papers as well. So the question mark is, are the concerns exaggerated, or should one really be worried for the space at large? Let's ask that question to Prabodh Agarwal from IIFL. And Prabodh, thank you so much for taking the time out and joining us. I would want to talk about IIFL too, but let's just start off with the situation as you see it in the NBFC space. Yes, there are concerns. Is there a crisis situation right now?
No, definitely not. It's more of a perception issue, concern about the market. That the IIFLs issue could become a contagious to the rest of the debt market. But it's more of it's just right now a lot of rumor mongering, and people are sort of excessively concerned, or there is a lot of fear, which is further exaggerated by the fact that the liquidity has suddenly dried up. Mutual funds are seeing redemptions, and because mutual funds have seen some redemptions, so therefore that is making the liquidity much tight. I think that is the situation, which is what leading to the current panic in the equity and the debt market. But I don't think there is such a fundamental concern.
No? Okay, so let's try and attack this point by point. Would you believe that funds that have to be raised, either for growth capital or because of the maturities that might be coming in, will necessarily have to be done northwards of 10% for a lot of NBFCs, if not all? And could that become a pain point? Because the common thesis that the market is working with, that you are raising, our NBFCs will be forced to raise funds northwards of 10%. The books for a lot of HFCs and some of the others, the loans have been lent out at 9%. How do you make money on that scenario? And two, if indeed the money is being raised at 10% or 11%, whereas banks are able to lend at a lower rate, then the growth for the next few quarters is also out of the window.
Yeah, so the thing is that you mentioned about growth capital. So growth capital, see, if the NBFC or HFC is in need of raising equity capital immediately, then obviously that will be next to impossible now, raising. So I don't think there are so many companies who are in need of equity right now. Most of the NBFCs actually are well capitalized. So I don't think people should be looking to raise equity in this kind of market. On the debt side, yes, of course, liquidity will remain tight or likely to remain tight in the foreseeable future, and therefore growth has to slow down. The kind of growth that we were seeing, 30-40% kind of growth, will slow down, and people will be more cautious. One, the underwriting standards will be tightened, and anyway, in the absence of, it's not that liquidity is available as much as you want, and therefore you will have to be much more careful about what you lend, who you lend to. I would think, therefore, the growth rates will moderate significantly for the entire NBFC HFC sector starting from third quarter. So the growth rates, which were, say, 30% plus, could settle down in the teens.
Interesting. So for you, and would you make that conscious call too, for you as a company, or you as the steward of the ship at IIFL, would you consciously raise the liquidity in your firm from what it is currently to a few percentage points higher, because liquidity, we don't know for how long will it remain tight?
Yes, of course. People are being cautious, including ourselves, and we would like to keep a little excess liquidity than what we were keeping earlier. We have also, in fact, we have redeemed a lot of commercial paper, short-term debt that we've had raised. That was anyway planned to be redeemed in this week, and we have done as per plan. So we have actually liquidated close to 3,000 crores of commercial paper this week. But we had lines of credit from the banks. The good thing is that the banks are lending. They are lending. Banks are lending, especially the PSU banks. They have been lending. All the large PSU banks have been lending, and the large private sector banks also have been lending, which is a good thing. I would think that their ability to lend probably would go up in the coming months and quarters, because of the fact that if there is an outflow of money from mutual funds, or at least the inflows slow down, so that incremental money has to go to banks, and therefore the banks will have more ability to lend. So that is a good thing, that they have been lending. Now people have been raising concerns that mutual funds and banks already have a very high exposure to the NBFC sector. Right, that is one question. I'm just preempting your question.
Thank you for that.
But the thing is that that is true in the last 2-3 years, that the NBFCs have been a prime borrowers, but that's because the growth in the other segments have been low. So industry has not really been growing that much or needing additional capital. The same goes for infrastructure, and therefore the bulk of the credit has been directed towards the NBFC sector. But the thing is that here there are sectoral caps in place, put in by the RBI for the banks and put in by SEBI for the mutual funds. So as long as we are within the cap, I don't think there is a need for a concern. But of course, the caps have all been hit, for a while, and therefore even before this crisis erupted, we have always had to sort of make sure that plead with the mutual funds or banks, to make sure that whenever the limit opens up, we get from that. But this limit hit has been there for a while. Now the thing is that within that limit, banks have been, or mutual funds have been lending. Maybe after this scare, the mutual funds would like to reduce their exposure. So that will make the liquidity further tight for the mutual funds, for the NBFCs. So that's why I feel that the growth will have to slow down, because the same amount of liquidity which was available from mutual fund will not be there. Maybe banks will support that, but still I'll have to slow down my growth.
Okay. So, two or three follow-ups that come in as a result of that answer. First, just a quick question. What in percentage terms, what percentage or what quantum of liquidity did you keep, and how much do you look to scale it up to because of the constraints that we might have?
So earlier I was keeping about 8 to 10% of my liabilities as liquid. That will go up to between, say, 13 to 15%.
Okay.
I must also add that, what type of liquidity. So what was happening is that earlier I was very comfortable putting this liquidity in liquid funds. But now many of us are actually not wanting to keep everything in liquid funds, want to keep something in bank deposits. Now it's a very sort of, it's an excessive cautious kind of stance, but that's the reality. Because, the NAVs of many of these liquid funds have also been falling. There is a concern that, the returns may be very low or, may not be there at all. And therefore, even though I get almost nothing in a bank deposit in a current account for 1 or 2 days or 3 days, but still I keep that. So that is the situation. Maybe things will ease from the next week, because right now there is a sort of quarter end squeeze also.
Okay, yeah, because of the advanced tax, I heard to that effect. Okay, the part two of my question there, we were talking about, you preempted one of my questions. A lot of articles around this, and therefore clarity from you would be helpful. MFs do have a large exposure. I understand the caps bit that you spoke about, but when some of the papers come up for renewals, and if the mutual funds who are facing redemption pressures are not able to renew, what happens then to that source of funding for NBFCs? Would they find enough takers at the PSU bank side or the banking side, and would banks be willing to do that? You mentioned that PSU banks are, for now in this week, willing to do that. Would they have the appetite to absorb all of that? Because some numbers that were floating around of the total exposure that mutual funds have to NBFCs, I think for NBFCs, non-HFCs about 70,000 crores, including HFCs, 15% of the book exposed in the mutual fund space. That's not a small number.
Yeah, so true, that is something which has to be seen, whether the entire deficit of the mutual fund is actually made up by the PSU banks or the banking sector.
Would it be need to be entire deficit, by the way? Or are we being just overly
I'm just being cautious. I'm just being cautious in the sense that, probably not necessarily in the form of outflow of the existing debt, but at least the incremental need may not be met by the mutual fund industry as has been the case in the past. I'm just saying that. So in that case, where is the incremental growth capital going to come from? So that will probably come from banks to some extent. Of course, a lot of NBFCs have been raising public debt, public issuance of NCDs, bonds also, that will continue. And of course, overall growth will slow down.
Okay. One quick follow-up before we get to the growth numbers as well. I think there was a comment that while people are being overly pessimistic about what happens to NBFC's source of funding, somebody mentioned this, that according to him, PSU banks will not be comfortable going out and lending to a lot of spaces that the NBFCs were lending to, because PSU banks don't have the wherewithal of collection measures the way the NBFCs do, and therefore instead of trying to take the entire cream of the gap that exists between the lending rate and the PSU banking rate, PSUs might be happy giving it to NBFCs as well to get that 4-5% that they get and let the NBFCs take that. So that source of funding may not stop over the course of the next 6 months. Is that a reasonable argument, Prabodh?
Yeah, I think so. I think so. See, the thing is that, the NBFCs, while people may have all kind of concerns on NBFCs, but NBFCs have a role to play in the economy and in the financial sector. The fact is that PSU banks are not present in a significant way in the retail space or in the MSME space, the segments where NBFCs are very active. And therefore, I would think that, NBFC as a channel of taking credit from the banks and disbursing to the end customer, that will continue. I don't think that is going to go away anytime soon. Our own experience has been that the PSU banks have been very comfortable lending to us, and also they have been very comfortable buying direct assignment or securitized asset from us, not only PSL but even non-PSL. So if they are buying non-PSL assets from us, that means they believe in our loan origination and our capability, and therefore they are happy taking even non-PSL loans from us. I think that will continue.
Okay, so funding not necessarily an issue, growth may be an issue, and maybe NBFCs too would go slow over the next couple of quarters. Now we come to the next big elephant in the room that the market is fearful of, and which is whether NPAs will come in a meaningful way across the board. Now, I know the common answer would be that NBFCs which have taken care, have followed the due diligence in the past, will probably be better served. But let's talk about the space at large. Is the situation bad enough for NPAs to come now? Because hitherto we are only talking about one NBFC defaulting, that leading to papers and the rates moving up, and that leading to cost of funding moving up, so on and so forth. We haven't quite examined what happens to the other side, which is the recoveries for NBFCs. Would SMEs, private owners, maybe property borrowers, the lap book that some of the NBFCs have, will that be an issue on the recovery front, Prabodh?
So the thing is that by and large, I feel that the asset quality, the assets that have been created by the NBFC sector over the last 2-3 years have been good. I don't think there has been any excess. Generally, if we are talking about a systemic level, at a systemic level, whichever segment we look at, whether it is home loan, whether it is LAP, whether it is SME, whether it is gold, whether it is commercial vehicle finance, whether it is microfinance, I don't think there are any systemic excesses. That is, people have gone completely overboard at a system level. Because you look at overall system credit growth, the overall system credit growth, the overall system credit growth has been around 13-14%. The retail credit growth, including home loans, has been growing at about 15 to 18%. That is nothing so alarming, right? Now, within that, of course, there will be pockets of problems. So, as I said, I'm not concerned at a systemic level. Okay. Now, there could be certain products or certain entities who could be in trouble, or who could see a significant increase in NPAs. So you mentioned LAP, for example. LAP could be one area where people have, they would have lent excessively, or their LTVs would have been much higher than what they are actually reporting or what they believe it to be true. And of course, the yields are not high to compensate for any loan losses of any significant measure. So that is one segment where you could see some increase in NPAs and increase in losses. Home loan, there could be certain segments, but by and large, I feel that home loan segment has been doing fine. SME, again, similarly, there could be some excesses, but broadly, I'm not too concerned about the asset quality NPAs, and I very genuinely believe that we are not going to see a huge increase in NPAs across asset classes.
Okay, just a couple of those points, and you have some exposure to some of these as well. I mean, your growth in microfinance, SME, etc., was doing very well. I'll come to that, but LAP predominantly. How high a percentage is it for you, and do you fear that there could be some NPAs? It's not predictable, but is there a possibility of some NPAs for you as well?
Yeah, so currently for us, LAP is about 17% of our total book. Our total book is 33,500 crore, 17% is LAP. We have not been growing LAP for the last 5 quarters.
Interesting.
So you will see last 5 quarters, the growth has been about 3 or 4%.
Was it a conscious decision?
That was a conscious decision. We have been saying that. The reason why we have not been growing that is because we didn't find the segment attractive enough. The yields had compressed to about 10.5% level. And at that level, we didn't find it attractive enough given the high OPEX and the high possibility of a credit loss. So that segment we had consciously stayed away from, and that has been coming down. In that segment, therefore, there could be some rise in NPAs, but I really don't see, because we have been stayed out of that segment.
Okay. Could it be a problem? I don't want to get into names, Prabodh, but you have a great hold on the industry as well. could there be an issue on the LAP book for some of the NBFCs? Again, not wanting to get into names, but do you see indiscriminate lending in that pocket for some quarters of the industry which might face a problem? I'm just trying to get a sense of what the risk could be for the system at large.
Yeah, so there is possibility that, that is there. But although, LAP is very difficult to generalize, because LAP, we talk in homogeneous terms, but actually LAP is not so homogeneous, because it is a SME lending, and the industry, the end user industry may vary. So, one is that, you may be lending to a trader, a wholesaler, a shopkeeper, or you may be lending to, an industry. And then within that, it could be several industries. So depending upon what is the end user of the industry, it could vary. So therefore, very difficult to generalize that, that will happen. Then the type of collateral also varies. Of course, it could be residential, self-acquired, it could be commercial. And then LTVs, of course, people have been liberal with LTVs. So we of course, 6 months back, we used to hear cases where the LTVs used to be 75%. And on top of that, people used to give unsecured loans, so making it 100% LTV. So obviously, those people will have issues. So by and large, yes, I would think that there could be some issues in the segment.
Okay, your microfinance book grew very admirably. I think the last quarter numbers as well, even though the base may be low, but the growth number were high. Maybe because the base is low, the growth numbers were high. Would that taper off? Would that see some issues? I mean, it's a very small pie, so may not really impact IIFL too much. But would you consciously taper the growth off there?
So right now, actually, we are very comfortable with our MFI book, and we are still growing it. So currently the book size is crossed 1100 crores. It's about 4% of our total loan book, and we actually have increased our presence in some of the eastern states where the credit culture we find is much better. States like Odisha, Bihar, UP, Jharkhand, Bengal. Those are the states actually where we have presence. Of course, traditionally we have had presence in Tamil Nadu, Karnataka, Maharashtra, but then these are the eastern states also we have added. So we find that there is enough growth opportunity. So I think, of course, we'll look at the liquidity, but from a asset point of view and the yield and the overall spread and the credit quality, we are still very comfortable.
Interesting. 2 worst case scenarios for IIFL now, or based on the way you see things right now, 2 numbers, and how bad can they get if you can predict them, that is. One is the NPS, if at all. The other is the net interest margins, which seems to be a common factor that NIMs for almost all NBFCs might come under pressure because of the ALM mismatch that some of them might have. Where are you on both of these?
Yeah, so I was expecting that question on NIM. So NIM is something which is, of course, very logical to expect that there would be some pressure on the NIMs. So I would also say that there will be some pressure on the NIMs for the next 2-3 quarters. That is because the cost of funds have gone up very sharply. And while we are sort of passing on this rate, but still it would be a bit gradual. So therefore, there will be some pressure on the margins. But having said that, it would vary again from product to product. There are certain products which are high yielding and where we are, the borrower is less sensitive to interest rates. For example, gold or SME or microfinance, where the passing on would be much quicker. There are other segments where it is much more gradual because of the entire industry structure, because banks are present and because, for example, home loan and LAP, where the passing on is more gradual. Even commercial vehicle to that extent, where it is gradual, where you could see some margin pressure, and the others there could be quick. But overall, I would think that yes, margins should remain muted or should be slightly under pressure for the next 2 quarters. But again, way that we are pricing is that if one were to look at a 1-year horizon, then margins should revert back to where they are.
Interesting. NPAs, the worst case scenario, as you see it right now?
Yeah, so NPAs could go up in certain segments, as we discussed, whether it is LAP or real estate or, some of these segments, we could see NPAs going up, maybe some in commercial vehicle. So there will be some pockets. Right now, we do not have a clear visibility as to which segment, where it will go up. It's a bit too early to say that. Maybe it will go up in December quarter or March quarter, not immediately. But yes, that is something we'll have to watch carefully.
Okay, my last question to you, Prabodh. You've seen many such cycles in the past as well, both as an equity watcher and as a participant too. How bad is the current scenario? How long could it last? Any guesstimates there?
Yeah, so the thing is that it is a bad situation, but of course we have seen it in the past. 2013 we saw, 2008 we saw. But yeah, this situation could last, typically 1 to 6 months, I would think is the...
That's it?
Yeah, so that is what... See, the thing is that, one is the abnormal tightening of liquidity, right? So, for example, now CP rates have gone up to 9% plus. Now that situation will not last for more than, I think, 1 or 2 months, probably even shorter. This is abnormal fear and the situation, right? But the interest rate tightening and the liquidity tightening will continue for a while. So thinking that, I don't see the G-Sec yield, for example, coming down in a hurry, and the overall liquidity being available to the to people like us, NBFCs, HFCs, will not improve significantly even over the next, will improve gradually, but it will remain tight over the next 6-12 months. But what I think is that, this fear and the extraordinary tightening should not last more than 1 to 6 months.
Okay.